welcome back to another episode of the Wealth Equation podcast. I'm your host, Maurice L. Wilson. Thank you for joining me again. Some of you who've been coming to the show pretty frequently, thank you for returning. You'll notice that my backdrop is starting to improve. It's not perfect yet. We're going to bring in some better lighting and some better, studio decorations. But bear with me as I juggle trying to become a podcaster along with my normal duties as a financial advisor and CEO of Wilson Wealth. If you're a client, thank you for joining. If you're new to the show, thank you for dropping in. And we do this every Wednesday. I promised I would start on Sundays as well, and haven't really been able to make good on that promise yet, but that is coming. So I want to do Wealth Live on Wednesdays and a Sunday or strategic Sunday show where we'll talk about some things to consider going into the week as we lead these busy lives in 2025 as we try to protect and grow our money in the face of what can only be called uncertainty, right? And so that's what we want to talk about today is this is particularly special because today Nvidia released their long-awaited earnings, and they were positive, and that's what we want to talk about. It's Nvidia's earnings. How does it impact, or how does it play with the overall story of the AI boom? And is the tariff story going to upend this boom? And is all that enough to save the stock market? So I did bring a presentation today. There we go, right there. So AI boom versus trade wars. Is Nvidia enough to save the stock market, right? So Nvidia has definitely become Wall Street's darling. It's definitely been a poster child for the AI story, AI being artificial intelligence, for those who are not initiated or with the term. And we're going to get into just AI in general, but I think you're going to find what I have to say to be pretty positive. But we've got to put some rationale on why that is positive, right? And why you can probably rest assured long term, but be very nimble near term as we try to get this AI story over the finish line and really over all these obstacles that we have going on in the stock market. So Nvidia released their earnings today, and they were successful. They did narrowly beat estimates, which sounds kind of like a C plus type of situation. But think of Nvidia as the LeBron James of the stock market, where there are all these expectations that have been heaped on them based on past actions and also based on some guy named Michael Jordan. Except in this case, Nvidia is both Michael Jordan and LeBron James. What Nvidia has done in the past, it's being engaged against today. And really, that's how all stocks are judged. But in the case of Nvidia, they've had such a big run over the last few years that Wall Street's greedy. Wall Street wants you to basically beat the estimates every quarter. And of course, trees don't grow to the sky. And in Nvidia's case, they can't grow to the sky because Nvidia is not only trying to meet these earnings, it's trying to meet these earnings with the added ankle weights of certain regulations put in place, not just by Trump, which a lot of people will be surprised to hear. One of the chief regulations that's hurting Nvidia's earnings was put in place in the Biden era, which was an attempt to kind of cobble or hobble China's explosive growth in the AI space. And so Nvidia can't operate fully in certain markets because the U.S. is trying to be competitive or hold on to a competitive edge. Now, Nvidia has tried to use the new administration, which is America First, to kind of say, hey, it'd be America first if you get rid of some of these curbs that have been put in place for some of NVIDIA's chips. Long story short, the current administration did not remove those curves, and so NVIDIA has had to take some losses. Um, and so that has definitely hurt the earnings, and it's to be determined on what that will mean each successive quarter if NVIDIA can't fully operate in all these markets. Nevertheless, NVIDIA stock, right before we did this show, we're live today on May 28th, 8:39 p.m. Right before we started the show, NVIDIA was up 5% in the aftermarket. A lot of people don't know, if you don't know what the aftermarket is, when stocks close, they go into an aftermarket trading session. Um, there's some pros and cons to being able to trade in the aftermarket, but if you want to know more about it, please stop by wilsonwealth.com. We do have the ability to trade in the aftermarket if your current broker or advisor doesn't. Nonetheless, NVIDIA stock was up 5% in the aftermarket. So right now, Wall Street is cheering what is not the greatest earnings report, but it's not a failure to beat expectations. So at the very least, I would say NVIDIA is having a strong C plus B minus quarter that they reported. So let's talk about semiconductors. So we throw these terms around: chips, semiconductors, they're the same thing. So you open up your computer. I just got a new computer. You get a black box or a laptop. A lot of the newer generations in the laptops. If you're like me, I'm old school. I want a desktop. I need room. I don't like those little screens. But if you pop open your laptop or your desktop, behind the screens and keyboards and whatnot are these boards, right? And these boards, you've got these little square or rectangular shapes, and those are going to be your chips. And that's basically the brains and guts and everything of the computers. So when we get into the AI trade, right? We are essentially talking about semiconductors. You can't have anything that we're calling the future without these semiconductors. And so that leads me to the AI boom, right? You got to have GPUs and TPUs and AI accelerators, and that's going to necessitate the likes of Nvidia and AMD and Broadcom at the center of the AI story. So think of it like when Wi-Fi was getting going, you needed somebody to create wireless routers, right, to really enable Wi-Fi, right? You can't have Wi-Fi without wireless routers and communications. Well, NVIDIA is the middleman of this future before AI and future with AI, and you got to have them. And so that when we talk about, can NVIDIA save the stock market? Really, the stock market is going to be saved by AI stocks in general, right? When people point to almost anything that's ailing the economy outside of tariffs, right? What ails the Main Street, mom and dad, not rich, but let's say career-oriented white collar worker? It's going to be AI, right? Lawyers, engineers, advisors, any technical, highly skilled knowledge worker is being threatened by AI. So on one case, it's an existential threat, right? The people just know it's coming. I mean, like we've been knowing it's coming in some format, really going back to the old Twilight Zone episodes, right? And so, in my opinion, if you've got something that's so fait accompli, then it's a no-brainer to be investing in AI stocks, right? I mean, you can't have this existential threat without AI stocks, right? So on the other hand, it's just the way that we're going to do business. It's the way we're going to have our cars. Like we're going to have a smart grid. We're going to have all of these modernized infrastructures, modernized houses, smart homes, smartphones, smart appliances, right? Where they can speak to you and say, hey, this is going wrong with your refrigerator, your microwave, your furnace, your air conditioner, right? All of that's going to take semiconductors. So when we talk about can AI and Nvidia, on the other hand, save the market, I mean, the answer is going to be yes, right? I mean, we would almost have to say we are not going to go forward into the future for AI not to be an integral part, or excuse me, semiconductors not to be an integral part of the market. And right now, it's primarily an Nvidia story, but I wanted to show this slide because there are other, semiconductor companies out there, and here's what they do. You want to familiarize yourself with all of these names. I'm also going to take this time to say I am not recommending any of these names. These are just what these companies do. Familiarize yourself with them because what will happen over time is the AI story, the semiconductor story, the investment story is going to broaden out beyond just Nvidia. It's kind of like saying that Microsoft was the only story of the dot-com, kind of revolution. And of course, it was Microsoft, it was Amazon, eventually it was Google, it was Yahoo for a while, right? So there are other stories in the AI space that you want to be aware of and familiarize yourself with. One that's not on here is going to be CoreWeave, right? CORWEAVE. CoreWeave is another one that's out there. Ironically, some names that have AI in them don't do as well. So beware of companies that just throw AI in their name just to kind of ride the coattails of this success. To put a fine point on it, my view on the future when it comes to AI is simply this. There are two hotels. It's 2005. One hotel offers one Wi-Fi. The other hotel doesn't offer Wi-Fi. Um, that hotel that doesn't offer Wi-Fi either goes out of business or it gets Wi-Fi. And that's kind of where we are with the AI. Whatever companies aren't using AI will have to use AI. And so you're going to have a 100% turnover, right? A 100% tech upgrade of everything involved in the modern economy, from rural America to urban America and everything in between is going to be upgraded with AI. And so, in my opinion, you really have to find a hole in that story for it not to come true. So that's my take on AI. Again, I'm not recommending any of these stocks. Now let's talk about, even with that being said, some of the near-term risks to the market, to AI, that are kind of being imposed on us, right? So we've got the $1 billion tariff haul, right? So this month alone, the administration came out and said, yeah, we collected 22 million in tariffs. That's up from 17 million in April. And so my thing is, we are very early into the ramifications of what tariffs have been imposed. So we keep focusing on the fact that tariffs were paused in early April, but they were paused for the new Liberation Day tariffs. There was a baseline 10% put on the entire world, for lack of a better phrase. And so what's been happening, of course, is companies are trying to pay those costs right now. So they're bearing the brunt right now because they're waiting for the new negotiated tariffs to come out, I think, in July, right? So they're not passing those costs off to customers yet. But they're only going to hold that line for so long, and then they are going to pass those costs off to customers. And that's where you're going to have the whole recession, stagnant economy come online because customers are going to make, or consumers are going to make trade-offs, right? On their purchasing decisions. They're simply not going to be able to afford extra taxes on goods. I think, we have stretched the US consumer to its end. I think, if you go back, people know the story, but let's do it anyway. 1950s, one income, right, is all you needed to raise a family of 3, 4, 5, 6, 7 kids. We all know the story, right? All right. And then in the 60s, 70s, we went to 2 incomes, right? And then in the 80s, 90s, we went to credit cards. That's how we had 2 incomes and credit cards to pay for everything. And then in the early 2000s, it was 2 incomes, credit cards, and home equity lines of credit. and refinancing, financing. And in between that, we had a booming market in the 90s and early 2000s after the dot-com crash to create what's known as the wealth effect. And I know a lot of people were out there taking money out of their 401ks to make things work, taking money out of their 401ks to send their kids to school, right? Along the way, college inflation went through the roof, right? So when I first got started in the business, when I would work with a client, we predicted, it wasn't hard to predict, annual college tuition would be about $25,000 around this time. That's exactly what it is if you're in state, $25,000 a year. And these same families that have two incomes, a bunch of credit cards, home equity lines of credit, refinance homes, and pulling money out of their 401ks are now taking out student loans for their kids and in their kids' names to put these kids into college. And now, on top of all of that, those kids who went to college early on in the early aughts and early 2010s, well, they're walking into economies where the jobs aren't quite paying inflation level salaries, right? I know engineers right now are coming out of college making less than what I made on an inflation adjusted basis coming out of college. So if you're an engineer in year 1, 2, 3, or 4, you should be making roughly 80 to 90,000 a year to start. That's not the average starting salary for engineers. So engineers are being underpaid and so forth down the line. So now you've got strapped Gen X parents, right? Two incomes, credit cards, home equity lines of credit, 401k loans, and now student loans. And now their kids are back at home living with them. And on top of all that, mom and dad, grandma and grandpa are moving in with the Gen Xers. So you're finding a lot of multiple generation homes all under one roof, trying to make things work. And then out of the blue, we now have tariffs, right? Well, there's just not enough to go around, right? And so these families are going to start making trade-offs on purchasing decisions. So if you run a business and a client who was coming in and buying something 5 days a week says, you know what, because your prices are higher, I'm only going to buy 4 days a week. Well, you have just had a 20% drop in revenue because 1 divided by 5 is 20%, right? And so, or 4 divided by, well, yeah, 1 divided by 5 is 20%. Yeah, got that right. Sorry, I had to check my math. So a 20% drop in revenue for a company can be all the difference because their profit margins are so thin. And so, and we've seen that with Target. Target had some things happen to their customer base based on decisions they made. And so they missed out on, let's say, a customer base that made up 10%, 13%, 20% of their customers. That dinged their earnings, right? And so Target has taken a big step back. And so I see a question here where they're saying, does it depend on location, salary, New York salary versus Tennessee salary? My experience has been, yeah, your New York salaries, your DC, Virginia, Maryland salaries are going to be a bit higher to adjust for that cost of living. So basically, a Tennessee client making 100,000, versus somebody making, or a Maryland client making 100,000 versus somebody in Tennessee making 75,000. The cost of living is still going to knock that down. I mean, at the end of the day, salaries need to be transposed up to where coming out of college making about 90, 95,000 is the norm, not the exception. If you truly adjusted prices for inflation. And we know this. We know a $100,000 income household is barely middle class now. You got housing prices that are crazy. You got egg prices that are crazy, car prices that are crazy, college tuition if you've got kids. Everything's expensive, right? And it's been expensive for a while, but salaries have been stagnant. So stagnant salaries plus a new tax called a tariff. This is threatening to knock the U.S. consumer out, and so we gotta keep an eye on that. So, can AI? We're just kind of recapping a little bit here. Can Nvidia save the stock market? Well, yeah, we're going to get to a chart to show you kind of how that's going to happen. But if the consumer in a consumer-driven economy gets knocked off their feet, market's not going to make it because we're a consumer-driven economy. So we've got to be careful with these tariff talks. And tariff talk, let's face it, I mean, it's all over the place, right? I mean, last Friday, we're going to, jack up EU tariffs, European Union tariffs to 50%. And then on Monday, we're not going to do it, right? So the markets, whipsawing back and forth. In fact, they came up with an acronym for the current, government and how they respond to tariff talks and things that are made. So tariff talk has just gotten to the point where it's almost where you tune it out. But even if you tune it out, it's still impacting the market and the confidence in the market. So again, AI is enough, but if tariff talks are out there, if tariffs are actually out there impacting the consumer, impacting the market psychology, then it's not going to be great. Um, so where are we, right? Where are we? I missed the uppercase there. Where are we, you know, in the markets, right? In the economy. So let's bring up some charts. Engineering is my background, but I'm not going to go overly technical, but let's bring up some charts that I like to go to whenever I get that type of question. So if you've been on some of my other videos before, you know I love the CNN Fear Greed Index. It's just like it's one of my favorite charts because it just kind of, I won't say it's perfect, but it really helps out when you want to know where we are. So I always start with this. When you go to CNN's Fear and Greed Index, you're going to get this nice little speedometer, if you will. And this isn't bad. I would say that, it helps just to know a snapshot of where we are. But the one I like the best is the timeline. And so anything near 75 is near, on this upper right hand side, you'll see 100, 75, 50, 25, 0. Anything near 75 means that we're entering or at extreme greed, right? Anything at 25 and below, we're at extreme fear. So extreme greed typically occurs when the market's going up. You get into what we call fear of missing out. Everybody's trying to buy, and eventually the market goes to a greedy standpoint. What you'll notice, though, if you look back at the October, kind of from the left to the right, you run into October, it doesn't stay at that extreme greed level for long. It never really does. And so whenever we get into the greed and extreme greed range, my radar's up because I'm like, okay, a lot of the easy money has been made. So if you think about it, we paused tariffs on April 8th, right? So from April 8th all the way up to, I'd say, last week, beginning of last week, easy money in the market, right? All of our trades were just booming. Things were flying back. And so it was easy, right? Clients would check their portfolios. How you doing, Miss Shani Belgrave? Clients would check their portfolios and, hey, everything looks good, right? Now, if they checked them early April, or if you check your 401k, it's not good, right? But the market has rebounded sharply. Well, typically when markets have a sharp rebound like that and they keep going, people try to catch up and get in. And the market is a contrarian. The market likes to get everybody in and then go back down for whatever reason. So when we started getting around the greed area, and we've been at the greed area. If I go back to the other slide, let's see, we were at greed 1 week. A month ago, we were at fear, but a week ago, we were at greed. So whenever we get to greed, I mean, I can mark my watch to some headlines coming out to knock us down. And sure enough, let's see, we had the EU headline. I think we had another headline about, man, I tell you so much I've forgotten, but it was something that came out that just kind of took the wind out of the market. We start trading flat. We start having, down days. It's just like clockwork, right? Now, it can still rise for a while in the extreme greed territory, but you can pretty much mark your clock that the market is going to make some type of temporary adjustment before rising higher. And guess what? We're seeing that now, right? Or that's what we've seen this week. I think last week was the first weekly loss we'd had in about 4 or 5 weeks. So that's where we are in terms of a sentiment, right? So I encourage you to go to Fear and Greed Index over at CNN. This chart is based on 7 indicators that you can get into, or not. You can just look at the charts like I do. I mean, the indicators are fine, but you know what it rolls up to is most important, and familiarize yourself. All right, so I did say that you know there was some news that came out that's going to take the market higher, and here you have it again, right before we went live with this podcast. Um, the judges, you know, the courts, they block some of these tariffs, right? This is all tariffs. Tariffs are taxes, right? So the courts are blocking some of these tariffs, which are a tax on the consumer. Remember, earnings drive stock prices, right? So earnings come from people buying your service or product. So if your consumer is not burdened with an extra tax, well, then the market's going to rise because they're thinking you're going to have higher earnings. So the futures, which is kind of a way of indicating how the market's going to perform the next day. I'm not going to get into too much in the futures now because it's a big topic to unpack. Maybe we can do that in a private group. But suffice to say, this little bit of news right behind the Nvidia earnings is taking the market up right now in the overnight market. So that's a good thing, right? That's a good thing. But it's still related to the tariff, right? The AI story is intact. It's just the tariff, right? And that's that near-term kind of risk that's impacting the market. Um, Before we go, I'm going to show you another chart. So on this particular system we have here, I don't have my pointer, but if you look on the far right of this chart, you'll see a black line and a red line. Okay, the red line is basically a short-term average of how the market is doing. The black line is a long-term average. When that red line, which is the short term, goes below the long-term average, that tends to be bad for the market. So you'll see when it first went under, the market was down lower than where it is now. Now, the trends are starting to kind of curve up, right? So things are improving. Think of it like you broke your leg a month ago and it's starting to heal. So you're hopping around a little bit more, but you're still on crutches. That's where the market's at, right? We broke our leg a month ago, about almost a month and a half ago. We're hopping around on crutches. We're not playing basketball. We're not, doing anything active with that leg. And we're just trying to heal, right? And any bit of news that takes these tariffs off the table is a positive for the market. The market is completely rallied off the idea that tariffs are not going to be as high as we initially thought. Any change to that narrative is going to take the market down. Nvidia or not, does not matter, right? And so we're literally beholden to the headlines. As we saw on the other slide, the courts came in, they blocked some parts of the tariffs, so the market's going up. And so that's kind of how we are. We're in this kind of world where we're just kind of living by the headlines. So strategy, I'm not going to tell you which one of these to do, but I will say what's been working, right? And really, 2 out of the 3 have been working really well. If you were fortunate enough to buy into some of that April sell-off when the market went down 18% from October of last year through April of this year, if you bought 60 days ago or so, hey, you've done really well, right? If you didn't sell from January 1st to today, and all you did was just keep your portfolio in place, you did okay. You took a hit though. You took a hit. Your stomach probably flipped, but things are looking better, right? Particularly if you're in a 401k where you're constantly putting money in every 2 weeks, things are looking good. The big question though is, do we buy now, right? Do we buy at these prices? Because a chart I should have put up here is when the market's up here, all the risk is up here. When the markets are down here, all the opportunities down here. Well, as you saw on this slide right here, we're kind of back up here. If you look at the far right side of this chart, we're kind of back up, right? So really, if you're buying now, I don't think it's a far-fetched idea to say this is one of the riskiest times to buy, because we're getting closer to that tariff deadline where we're going to kind of announce whatever the tariffs are going to be, right? Who knows how that's going to happen, right? Who knows what that's going to look like? We're in the middle, or we're coming to the end of the second quarter, right? And so earnings are going to be coming out for the second quarter at some point. If we have another negative quarter on the gross domestic product, economists may determine that we're in a recession. That would be bad for the market. So buying now, I'm not saying don't do it. I'm not saying do it, but and add in that we're at the greed level on the fear greed index. It's a lot to consider, right? So the strategies that have probably been working best for people so far this year have been buying low and buying and holding. So really, if you don't know where you stand and what to do, definitely recommend calling me, or just visiting our website, wilsonwealth.com. We're on LinkedIn at Wilson Wealth. Our YouTube is streaming on the bottom here, but Wilson Wealth / The Wealth Equation Podcast. Instagram at Wilson Wealth. You can definitely find us at any of those locations. We do this every Wednesday, and we're getting better every Wednesday. As I kind of get acclimated with talking to a camera on Wednesday evening. So definitely, if you're joining me, tell your friends, bring a friend back, and we'll continue to make this happen. It's not always just me. Last week we had a really good podcast with government contracting that I thought was really informative. So if you're in the government contracting space, I encourage you to go back and look at that podcast from last week. And just join us every Wednesday. And like I said before, soon to be Sunday, where we will be talking about strategies going into the week. And on Wednesdays, we'll be talking about what's going on in the markets and also having guests. So thank you for joining me. My name is Maurice L. Wilson. This is another edition of the Wealth Equation Podcast. Thank you.